All right, hello and welcome everybody to today's webinar. Today we're going to be talking about managing money and risk in trading, one of the most important topics in trading and one that's often overlooked. This is stuff that can really be a key factor in your success as a trader. So I'm looking forward to share with you some key concepts today. Without further ado, let's jump right into it, guys. First of all, a little housekeeping. Risk disclaimer: trading on margin carries a high level of risk and may not be suitable for all investors. You should not invest money that you cannot afford to lose. Secondly, a hypothetical trading disclaimer. The information in this webinar is provided as general market commentary. It doesn't constitute investment advice. We're not giving out specific trade recommendations. Let's take a quick look, everyone, at what we're going to cover today in today's presentation. We're going to look at the psychology of trading, some of the key points. I think many of you who are spent some time trading will be able to relate to what we're going to talk about in a minute. We're going to talk about drawdowns, that is, refers to losses or a series of losses in the market. Recovering lost equity, we're going to look at some shocking statistics about how it's very difficult from a percentage basis to recover lost equity and why it's so important to have the risk management practices in place. We're going to talk about the 2% rule, classic money management rule. We're going to talk about reward to risk ratios that can tilt your odds of success favorably. And we're going to talk about stop loss strategies, a variety of different stop loss strategies. And take a look at a professional money management strategy that has been used by one of the most successful money managers of all time, with one of the most consistent track records of all time, money manager by the name of Ed Thorpe. And so we're going to talk about this strategy, the Kelly Criterion that he used in his trading. So first up, let's look at some stuff that relates to the psychology of trading and behavioral economics in trading. We're going to look at an academic study which has shed some really interesting light on the subject. So behavioral economists, academics studying this, have shown that people inherently make irrational decisions when it comes to investing and trading. It doesn't come as a huge surprise, right? Because most of us know that the majority of retail traders are losers. So in a classic study by Kamen and Tversky, subjects were given a choice between a certain $3,000 gain versus an 80% chance of a $4,000 gain and a 20% chance of getting nothing. So maybe what would you do in that situation? In that situation, I would probably choose the certain $3,000 against the 80% chance of $4,000 and 20% chance of getting nothing. So it's a binary choice. A large majority chose the $3,000 gain. No great surprise there. When it gets really interesting is when you flip the question to the inverse. So the question was reversed, and subjects were given a choice between a certain $3,000 loss versus an 80% chance of losing $4,000, along with a 20% chance of losing nothing. So how do you imagine that the majority of people reacted to these options that they had? In this case, the majority chose to take the 80% risk of losing $4,000 and the 20% chance of losing nothing. So when it comes to risk-taking, we see that people are more open to take risk in losing when there's a potential for loss. In both cases, people leading the study came to the conclusion that people made irrational choices from a mathematical perspective when calculating an expected win or loss. So how does this relate to trading? So the study relates to trading investing in a very profound way. Jack Schwager is the author of the Market Wizard series of books, and he also wrote an excellent book called Market Sense and Nonsense, and he sums it up really well as follows. So this experiment reflects a quirk in human behavior in regards to risk and gain. People are risk averse when it comes to gains, but are risk takers when it comes to avoiding a loss. This behavioral quirk relates very much to trading and explains why people tend to let their losses run and cut their profits short. So what I might add, based on my experience as a trader and a broker, this is the single biggest problem that people come up against in their trading. They typically allow their losers to run or double down on losers, and in the opposite way, they cut their winners too short. So this is the classic problem that you see in both retail and professional traders. Let's talk for a minute about drawdowns. Drawdowns are basically a losing streak, but more technically speaking, drawdowns are a peak to trough decline during a specific recorded period in your trading. So you want to keep in mind that losing trades are an inevitable part of your trading, and you might have a strategy with a really high success rate, but you could start out with a succession of losing trades. So for example, you might have a strategy with an 80% success rate, and you might start out with a string of 10 losing trades. So wouldn't it be a shame if you blew out your account in those first 10 trades when the following trades all would have been winners statistically? So the idea is that with proper risk management in place and a good strategy, not enough just to have good risk management, you've got to have a good strategy also, you'll be able to survive these drawdowns, these strings of losses, and be consistently profitable over the long term. Let's talk for a second about the 2% rule. 2% rule is a widely respected concept in trading and money management, and it suggests that you shouldn't ever risk more than 2% of your account equity on a single trade. So for each individual trade, you don't want to be risking a high percentage of your account equity. Market Wizard Larry Hite, this is another pro trader profiled by Jack Schwager in his Market Wizard series. He was even more conservative. He never risked more than 1% of his total equity on any trade. And by risking only 1%, he was indifferent to any individual trade. He wasn't freaked out by what the consequences might be to any individual trade. He was able to keep, a clear head by having that limited risk. So when you use this rule, or a similar rule, 1%, 2%, maybe 3%, if you're less conservative, you should be able to survive a substantial drawdown. And if you have a good strategy, you should be able to reap the benefits of that good strategy instead of getting blown out by a string of losing trades. But if you were risking too much, if you were risking 10% of your capital on each trade, you could easily wipe out your account with just a short series of losing trades. So that's the situation that you want to avoid, and that's what's going to prevent you from being successful in the long term and making the most out of a profitable strategy that you've identified. You could also apply this rule on a longer time frame. Alexander Elder talks about this in his book, Come Into My Trading Room. He suggests that if your account falls below 6% of its closing value the prior month, you should just stop trading for the rest of the month and clear your head. So in the short time frame also, let's say you lose 2% of your equity on the day time frame, it's probably the best idea just to walk away and reevaluate what went wrong rather than trying to make a comeback that day. Similarly with the 6% rule, if you had a bad month, you should just it's an idea just to walk away, reevaluate everything, maybe do some more back testing of whatever strategies that you're working with. So you want to think both about the short time frame and the longer time frame. Next up, let's talk about recovering lost equity. So when you lose money in your trading account, the percentage of the return needed on your remaining capital to recover, just to get back to even, is shockingly high. Let's take a look at the following percentages required to recover from significant percentage losses in your account. So, for example, a 25% equity loss requires a 33% return to recover. A 50% equity loss would require a 100% return to recover your former equity. A 75% equity loss would require a massive 400% return to recover your former equity value. So the more you lose, it becomes increasingly hard in percentage terms to recover to break even. So this point underscores why it's so important to effectively manage your risk. Let's look at the conventional wisdom when it comes to risk to reward ratios. For some of you that have attended my previous webinars, very often I talk about having a greater reward to risk ratio, so maybe a 3-to-1 ratio. So the conventional wisdom states that if you give yourself a profit target larger than your risk allowance, you increase your chances of being successful in the long run. So for example, you might experiment with using a ratio of 3-to-1. So in this instance, your profit target could be at 30 pips with a stop loss at 10 pips. Or for a longer term trade, a swing trade, maybe you might have a profit target of 300 pips and a stop loss of 100 pips. I have actually seen trading strategies with the opposite of this, with short profit targets and larger stop losses. So not everything is set in stone, but this is, generally speaking, a good model to start working with. And now let's look at some different stop loss strategies. So this is where you're placing your order, the stop loss order, to protect yourself in your trade from losses. So first of all, you could start using an equity stop, where you used a fixed percentage of your equity on a trade to determine the placement of the stop loss order. Second, you might use a chart stop. So this is what you see most commonly used. This is where you're looking at the chart, you're looking at historical price data and technical analysis, support and resistance levels, trend lines, that kind of thing. And you're using that to determine where to put your stop loss. A third method, which you don't see so often but is interesting, is using volatility as a measure of where to place your stop loss order. Let's talk about the volatility stop for a minute. So in a highly volatile market, the stop loss should be wider, and in a lower volatility setting, the stop should be tighter. That's fairly intuitive. And how can you determine the level of volatility? Well, there's indicators out there, such as Wells Wilder's average true range is one of the better known indicators for measuring volatility. So when you're placing your stop loss strategy, you can experiment with all three of those, maybe a combination of all of them also. Let's talk about the Martingale system. You may have heard this in the context of casinos and gambling. Martingale is a money management system where the size of the investment continually increases after losses. And so the principle behind this system is that statistically you cannot lose all the time, and therefore you should increase the amount allocated in investments after losing in anticipation of a future gain or winning trades. So by continually increasing your position size, the theory holds that the trader will come out profitable. So imagine the situation where a trader has a losing trade, they're down money, excuse me, they haven't got out of the trade, they're in a losing trade, they're down money, they double down on the trade. They lose money, they double down again with greater size, until eventually the expectation is that the market will turn around and they'll recover their losses. This assumes an unlimited supply of capital. Of course, most traders are going to run out of money sooner or later. So this is a very, very dangerous system to apply. At a glance, I would say it's completely crazy to engage in this, but I've actually, some trading educators who have trading rooms have used the Martingale system and been surprisingly successful for a period of time. But inevitably, usually, there's a huge blowout, an account blowing out trade that wipes them out. Then we can talk about the anti-Martingale system. So the anti-Martingale system is the inverse, where more risk is taken after profits and risk is tapered after losses. And now this is what I was told to do as a trader. This is kind of what the conventional wisdom is to, when you're ahead, to lean into it, to increase your position size when you're ahead, and when you're losing, to decrease your position size. So this is the advice that I would give to traders, especially new traders. Be conservative when you're losing, and when you're ahead, lean into it. Be more confident. Maybe up your position size. That's a time when you should be on the offensive. So that's the Martingale and anti-Martingale systems. Next up, we're going to talk about a money management system used by the money manager Ed Thorpe, one of the most successful money managers in history, with one of the most consistent track records in history. 20% gains a year over decades, which is, he's an outlier. There's very, very few managers that have done anything close to that. So let's take a look at the Kelly Criterion quickly. Kelly Criterion was originally developed by John Kelly while working for AT&T's Bell Laboratory. When the method was published, it was first used by the gambling community and later regarded as an effective money management tool by the investing community. So first of all, used by card players in Las Vegas, and then later adopted by Wall Street. So it looks at two major inputs. The probability that a given trader or system will be a winner is W, and then R is the win-loss ratio, the amount gained from winning trades divided by the amount lost from losing trades. And here you can see the formula. Kelly percentage is derived using these in an equation as follows. So this percentage that you got at the end using that formula is used to show your optimal position size. So a Kelly percentage of 0.8 suggests that you should take an 8% position in the securities in your portfolio. In the context of gambling, the formula dictated the percentage of capital to be bet on each iteration of the game. And as I mentioned, the formula was used by Thorpe, who was a money manager and a mathematics professor, both in blackjack and the stock market, with a spectacular degree of success. The system helps you limit your losses and maximize your gains through efficient diversification. And as I mentioned, hedge fund manager for 28 years, he returned an unprecedented 20% return per year. So he did tremendously well, and one of the key parts of his success was using mathematics and using it in the context of managing money and using it to diversify in such a way. If you want to get deeper into this, there's a book about it, The Kelly Capital Growth Investment Criterion by Leonard McLean. So to conclude, here are the key things that I want you to take away from today's presentation. I would like to recommend using some version of the 2% rule as a circuit breaker. What I mean by that is that you have a loss limit. Once you've lost a certain amount of equity, you just walk away for a set period of time. So you have a series of losing trades, you lose 2%, you just shut it down. You don't keep trading. You walk away and you think about what you did wrong. Maybe do some trading on a simulator, tinker with your strategies a bit more. But you use it as a circuit breaker in the sense that everything shuts down when you've lost that set amount, and you don't get into sort of a bad state emotionally and make bad decisions. This is really key. Just remember what we talked about from the study, that human beings are typically wired wrong instinctively in terms of risk management and trading. So they're willing to take more risk when they're losing, which is what they should not be doing, and then they're risk averse when they're winning, which is what they should be open to risk when they're ahead. And if you understand this, then you're going to be ahead of, in a sense, you're going to be ahead of the majority of the traders in the market. So I think that's a really key point. And then finally, that drawdowns are inevitable. So you're always, every trader has losing trades, whether you're Ed Thorpe or George Soros or whoever it is. But the thing that distinguishes the winners from the losers is proper risk management and a good trading strategy. Of course, you need the trading strategy. And when you have those two things, you can view yourself, in a sense, as the casino owner. You may have heard this analogy before. So occasionally, you'll have to make payouts. So that represents the drawdowns, because you're going to have losing trades. So occasionally, you're going to have to make payouts. But over the long term, with a good strategy and good risk management, you can take profits by having the odds tilted in your favor. So with that, everyone, I want to thank everyone for joining us today. If you have any questions, please do shoot them over to webinar@OctaFX. And look forward to seeing you again. Good trading, everyone. Bye for now.